He had $320,000 sitting in a term deposit at the Commonwealth Bank. It was earning 1.8%. He knew that because he had checked twice on the statement that arrived in the post at his place in Marion, the envelope sitting on the hall table for 2 days before he opened it. 1.8%. That was about $5,700 a year in actual interest. But when Centrelink assessed his income for the age pension, they did not use that number. They used a different one, a higher one. And when he saw what they had calculated sitting in the waiting room at Services Australia with the assessment letter on his knee, he thought there had been a mistake. There had not been a mistake. That was Deeming. If you have ever looked at your Centrelink income assessment and thought, that is not what my money actually earns, stay with me. Because today I am going to explain Deeming rates, what they are,
they know we're here.
Uses them,
we have to leave
and
right
why
now
the number on
before
your
they close in.
Might be higher than the number on your bank statement. Let me start with the principle, because once you understand why Deeming exists, the rest of it makes sense, even if it still frustrates you. Centrelink does not want to track the actual earnings on every bank account, every term deposit, every super fund, and every share portfolio for millions of Australians. That would be an administrative nightmare. So instead of asking, what did your money actually earn this year?
This policy shift represents a major departure from the previous administration's.
Your financial assets are earning a set percentage, regardless of what they are actually earning. That assumed rate is the Deeming rate. It is a simplification, and like most simplifications, it works reasonably well in some situations and feels deeply unfair in others. Under current rules, there are two Deeming rates, a lower one and a higher one. The lower rate is 1.25%. That applies to the first $66,800 of your financial assets if you're single, or the first $110,600 if you're a couple. Everything above those thresholds is deemed at the higher rate, 3.25%. Now, let me show you what this looks like with real numbers, because that is where Deeming stops being abstract and starts being personal. Take a single person with $300,000 in financial assets, super, savings, term deposits, shares. Under Deeming, the first $66,800 is assessed at 1.25%. That gives about $835 a year. The remaining $233,200 is assessed at 3.25%, about $7,579 a year. Total deemed income, roughly $8,414 a year, or about $323 per fortnight. The income-free area for a single person, the amount of assessed income you can have before your pension starts to reduce, is $226 per fortnight. So this person is over by about $97. At the income test taper of 50 cents, for every dollar over, their pension reduces by about $48.50 per fortnight. Now, here is the frustration. If their savings account is actually paying 1.5%, not 3.25%, their real income from that money is significantly less than what Centrelink assesses. They are being penalised for income they are not earning. And that gap between the deemed rate and the actual
As you can
rate
see here,
is where the
income-free
lives.
area is set
It
at
is real,
$192.
It is common, and it is completely
Then we look at the
understandable.
threshold.
But there is a second side to this, and in fairness, it is worth understanding. Deeming also works in the other direction. If someone has their money in a share portfolio returning 7 or 8%, Centrelink still only deems it at 3.25%. They are assessed on less income than they actually earn. The system is designed to be neutral on average, but for any individual, it can feel like it is tilted against them. Now, here is the part that catches most people. Which assets are deemed and which are not? Financial assets that are subject to deeming include bank accounts, term deposits, managed funds, shares and listed investments, superannuation once you reach pension age, account-based pensions, bonds, debentures and loans you have made to other people. If it is a financial asset that could theoretically earn a return, Centrelink deems it. Assets that are not subject to deeming include your family home, your car, your furniture and personal effects, real property like an investment property, though rental income from property is assessed separately as actual income, not deemed income. That distinction matters. If you own a rental property, Centrelink counts the actual rent you receive, minus expenses. But if you have the same value sitting in a bank account, they deem it. Same dollar amount, different assessment method. That inconsistency is one of the reasons deeming generates
Check the coordinates, they're unstable.
And here's
Recalibrating now.
Most
Stand by for
explanations
sequence
stop.
initiation.
But there
Do
is
it
a
now.
layer
We are running
underneath
out of
this that most people have never had explained, and it is genuinely important. The income test, which uses deeming, is only one of two tests Centrelink applies. The other is the assets test, and Centrelink runs your numbers through both. Whichever test produces the lower pension, that is what you receive. So even if your deemed income is relatively low and the income test treats you generously, the assets test might be the one that actually determines your payment. Understanding which test is binding for your situation changes which strategies make sense. That interaction between the two tests is something we have covered in detail, because the two tests pulling in different directions is where the real complexity lives. Now, let me address the question I hear most often about deeming. Can you do anything about it? The honest answer is, you cannot change the deeming rates. They are set by the government and apply equally to everyone. But you can be aware of how the thresholds work, and in some cases, the structure of your assets can make a difference. For example, if you are a single person with financial assets just above the $66,800 lower threshold, a large portion of your money is being deemed at the higher rate. If you shifted some of that money into a non-financial asset, like paying down debt, making home improvements, or prepaying expenses, the amount subject to deeming falls. That is not a loophole. It is a legitimate part of how the system works, but it is the kind of thing worth discussing with a qualified financial advisor before you act on it. And there is another factor worth understanding: your superannuation. Once you reach pension age, your super balance becomes a financial asset subject to deeming. How your super is structured, whether it is in accumulation phase or an account-based pension, which investment option you are in, does not change the deeming calculation. Centrelink deems the total balance regardless, but the structure does affect other things, like the tax you pay inside the fund and the minimum amount you must withdraw.
This figure on my super statement is incorrect on your assessment here. I understand. Let me look into that for you.
When you see the full picture, the interaction between super deeming and the assets test becomes much clearer. If you want to see your current deemed income, you can check through your MyGov account under Centrelink Online Services. It will show you the financial assets they have on file, the deemed amounts, and how the income test has been applied. If the figures are wrong, if they have an old bank balance or a super balance that has changed, you can update them online or by calling Services Australia. And I will tell you, keeping those numbers current is worth the effort, because even a small change in your assessed assets can shift
the indexed
your
annuity
deemed
option
income
we discussed.
and change
It
your
provides a
pension by
guaranteed
few
income
dollars
floor. Right, so
per
even in a
fortnight.
downturn.
Over a year, that adds up. And if you're unsure about any of this, if the numbers feel confusing, or you're not sure whether the income test or the assets test is the one that matters for you, talk to a qualified independent financial advisor. Someone who charges a fee for advice, not a commission on a product. A good advisor can model your specific situation
that is
and
wonderful
show you exactly
news.
where you stand.
Yes, I'll be done here in about an hour, and we should celebrate tonight.
Deeming rates are the formula Centrelink uses to assess income from your financial assets. They do not look at what your money actually earns. They assume it earns 1.25% on the first $66,800 and 3.25% on everything above that. The gap between what is deemed and what is real is where the frustration comes from, and that frustration is completely valid. But understanding how the formula works puts you in a better position to plan around it. But there is something else worth exploring, something that connects directly to what we have covered today. The deeming rates are only part of the income test, and the income test is only one of two tests that determine your pension. The other, the assets test, has its own thresholds, its own taper rate, and its own logic. How those two tests interact
the early
is one
bird
of the
catches
most
the worm.
misunderstood parts of the entire pension system, and it is something we will cover in full, because understanding which test controls your pension changes how you think about every financial decision in retirement. If this helped make sense of something that felt unfair or confusing, share it with someone you know who has looked at their
Push it straight back, watch your feet,
and thought the numbers were wrong. Sometimes they are wrong.
Clear the way,
and sometimes
pallet
the
jack
system
coming
is just
through.
working in a way nobody ever explained. And I'm curious, have you checked your deemed income on MyGov? Does it match what your savings are actually earning? Tell me in the comments. I read every single one, and your questions genuinely shape what I cover next.